Hello students, and welcome back to this explanation on standard costing, and this is standard costing explanation part 2. I mentioned in the video for part 1 that we will be dividing standard costing into 4 main parts for explanatory purposes, so therefore we are now on the second part, and this part is dedicated only to fixed cost. So in part 1, we contemplated calculations for your variable overhead, your labor costs, as well as your material. In this part 2, we will only be looking at fixed cost calculations. So as a third year student, I'm quite comfortable with the fact that you already understand fixed cost, but I have inserted a graph here for you just as a reminder. And fixed costs are those costs that do not vary in accordance to the number of production units that we have as output. So it doesn't matter how many units we produce, the fixed cost remain constant as demonstrated by this straight line. Right, what is important in terms of standard costing and fixed costs? Well, it's very important to take into account that each question will tell you a type of costing system that is applied. So when you do a standard costing question, we are going to tell you either that the business applies marginal or direct costing or absorption costing. So these are two different costing systems that you would have learned about in your second year, but they will now influence the type of calculations that you perform when a standard costing question is calculated, especially in terms of your fixed cost. So the first costing system that we can tell you in the question, and it must be told in the question, you cannot assume, but the first one that we will tell you is marginal costing. So marginal costing refers to a situation where your fixed costs are not included when the cost per unit is calculated. So your fixed costs are basically accounted for as a period cost when you set up the statement of comprehensive income. So very important to remember, the cost per unit excludes any fixed costs. If we tell you in a question for standard costing that marginal costing is the costing system that this business applies, there is only one type of fixed cost variance that you will calculate, and that is your fixed spending variance. So there is only one variance to calculate when we work with a marginal costing system. And this spending variance is the difference between your total budgeted fixed overhead and your actual fixed overhead. So right now, this may not make a lot of sense, but it doesn't matter because by the end of the slideshow, I have an example that will clearly explain to you how each type of costing system must be approached when you do standard costing in calculating fixed cost variances. The second costing system that we can mention is absorption costing. And I have put a picture here of a sponge because absorption costing refers to where the fixed costs are absorbed into your cost per unit. This means that it actually then, the cost per unit includes your fixed cost. And generally, this is the most widely accepted method in calculating cost per unit because that is the valuation method that SARS prescribes. If you opt to do marginal costing in your business, which you could do, you must take into account in terms of IAS 2, there will be differences in tax, and therefore you will have a situation where there is a deferred tax and an income tax effect. So it's important for you just to know that absorption costing is the one that we basically then apply so that we don't have any differences with SARS, because of course nobody wants to calculate those difficult income tax, deferred tax calculations. But I need not tell you about those. I'm sure you are familiar with IAS 12. Right, if we tell you in a question that absorption costing is indeed applied as evaluation method, then there are basically 4 fixed cost variances that you will apply. So in the first instance, you will still calculate your spending variance, which is the exact same calculation you would have done if marginal costing were applied. However, there's now also a fixed volume variance that needs to be calculated. And this volume variance is spread into 2 little legs. The one is called the fixed efficiency variance and the other is called the fixed capacity variance. And if you add your efficiency and your capacity variance, you get to your volume variance. So there's 4, the spending variance and the volume variance is split into 2, the efficiency and the capacity variance. Righto. As always, I like to use a block format to do my calculations in terms of efficiency, capacity, and volume variance. To do that, I use the abbreviation that I like to call FAB. So FAB, as you can see there. And the F stands for total flexed hours. The A stands for total actual hours. And the B stands for total budgeted hours. And then in the last column, we have the rate per input. So again, right now, this will seem very unfamiliar to you, but I have an example and then you will understand clearly. I have put the formula for each type of hour in the block A as well. So to calculate flexed hours, we're going to say the budgeted hours for a unit times the actual units. The actual hours are normally given in the question. The total budgeted hours are the budgeted hours per unit times the budgeted units, and then the rate per input is also normally given. So the difference between your actual hours and your budgeted hours will give you the capacity variance. The difference between your flexed and actual hours will give you your efficiency variance, and the difference between your flexed hours and your budgeted hours will give you your volume variance. Again, this will sound very abstract, but we have an example that we're going to look at. For the spending variance, unfortunately, this is only one formula that you have to study so far. In total, there will literally be 2 formulas to study that are really, really simple. So the spending variance is that your total fixed overhead minus your total actual fixed overhead. So it's the budgeted minus the actual. But let's go to an example. And this example will seem familiar because this is the example that we used in the previous set of slides, part 1 as well. However, I've now added some fixed costs to it. So this example says that VUT Limited produces a single product and they have the following standard cost. And the focus must now be put on the fixed cost. So we're going to focus on that fixed cost there. I just want to highlight it. Right, I don't see a highlighting function here. Let's make it then in red. And then I want to focus on the actual fixed costs that were given here. Right, so this is the bit of information. And then what I've changed is now to say that all overhead is based on labor hours. So you will see that there's 3 labor hours. There's 3 hours for variable overhead, 3 hours for fixed overhead. Right, so let's see. If we told you in the question that marginal costing is applied, you would only calculate one variance, fixed cost variance, and that is your fixed spending variance. What is the formula there? We need to take your total budgeted fixed cost minus your total actual fixed cost. Now, the total fixed cost, the actual total fixed cost was already given as 50,000. So I only need to go and calculate what the budgeted fixed costs were. So how do I calculate the total budgeted fixed costs? That will be your total budgeted fixed costs are equal to 4.50 per unit, which is your budgeted. Let me first type out the formula. It is your budgeted cost per unit times your budgeted units. So in this instance, it will be equal to the budgeted cost per unit was 4.50 and the budgeted units were 10,000. So it is then 4.50 times 10,000, and that gives us, if my math isn't too bad, 45,000. So then to fill out the formula to get to your answer for the spending variance here, we will then say the budgeted fixed costs were 45,000. The actual fixed costs were given as 5,000. And that gives us a fixed spending variance of minus 5,000 Rand, which is then unfavorable. All right. Then let's say we are applying our absorption costing. Now we know that there are 4 different variances that we calculate. And efficiency and capacity, oops, let's not do that, should add up to the volume variance. So the spending variance is easy. It will already be the same. The problem will be to figure out the volume, efficiency, and capacity. So that's what we draw the block for. Right, the block fab, flexed hours, actual hours, budgeted hours, and then we need the rate per input. The rate per input is quite easy because normally it's given. If I go to the question, what are the inputs? Hours. So please remember, inputs are hours, liters, meters, and then we have the per unit values, which is 20 Rand, 18 Rand, 9 Rand, 4 Rand, 50. So the per input rate is 1 Rand 50 per hour. So I'm going to go and I'm going to fill that out. 1 Rand 50 per hour. Right. Then what is the total budgeted hours? There we need to calculate and say the budgeted hours per unit times the budgeted units. So what are the budgeted hours per unit? 3 hours per unit. What are the total budgeted units? 10,000. So there I'm going to say it is then 3 hours times 10,000 units, and that gives us 30,000 hours. The actual hours should not be difficult to figure out because all the overheads are based on your labor hours, and the actual labor hours were 38,400. So that one normally given, I can just go and fill it out. It is 38,400 hours. Then what are the flexed hours? The flexed hours are budgeted hours per unit times actual units. So what's the budgeted hours for a unit? The budgeted fixed cost hours is 3 hours per unit. And what are the actual units? 12,000 units. So I'm going to say there it is then 3 times 12,000. And if my math isn't too bad, that should give you 36,000 hours. Right, now you have all the necessary information to do your calculation. So I'm just going to insert here a text box so that I can type. So the first one that we are going to calculate is your capacity variance. I like to go in alphabetical order. So I do capacity, then efficiency, and then your volume variance, your fixed volume variance. So the capacity is the middle one. We minus the one to the right and we times by the rate. So for the capacity, we are going to say it is the actual hours, 38,400 hours, minus 30,000 hours budgeted, and we times it by the rate R1.50. That gives me an answer of, I'm just calculating on my calculator, I get 12,600 favorable. My efficiency variance is the flexed, so it is the left minus the middle. That is then 36,000 minus 38,400 in the middle times the rate of R1.50, and that gives me on my calculator a negative answer of 3,600 unfavorable. Then the volume variance is the flexed and the budgeted difference. So that will be your 36,000 hours minus your 30,000 hours times R1.50, and that gives us how much? 6,000 times R1.50 gives me 9,000 favorable. And you can even cross-check if you are right, because capacity plus efficiency must give you volume. So you need to say 12,600 minus 3,600 gives you 9,000. So you are sure that you have not made a mistake. So this is how we do those three variances when we have an absorption costing system. So you need to do your fab block, and I will advise you to actually draft this block as an additional calculation so that we can see where your answers come from. Right, then there's also another one. If we do your absorption costing method, there's also a spending variance that we need to calculate. But the spending variance is the same as the one we calculated for your marginal costing. You can't say it's a spending variance and then we have a different answer under different costing systems. No, it will still be your total budgeted fixed cost minus your total actual fixed cost. I believe we calculated the budgeted fixed cost to be 45,000. The actual fixed cost was given as 50,000. And I remember we had a minus 5,000 unfavorable answer. And you will see it is the same under marginal costing. All right, so I just wanted to bring this under your attention. It's important to go and see, but what are the different costing systems? There is a shortcut for your capacity, efficiency, volume variance to calculate. Yes, so I hope that you've enjoyed this video and that you've learned something new. And if there is any additional assistance required, please feel free to also send me an email. All right, keep well until we see each other again.